Individual investors have more investment options than they often realize. In this webinar, we welcome Richard Ho from the Montreal Exchange. Richard introduces us to the building blocks of option trading while breaking down key terms. We discuss the concepts of exercise and assignment and how they can impact you. And without further ado, I welcome my guest, Senior Manager at the Montreal Exchange, Richard Ho. How are you, Richard?
I'm doing great, Ryan. How about yourself?
I'm good. I think I'm doing good. I'm really excited. I know that before we get started, you have some disclaimers to go through. So I'll let you go through that, and then we'll get to the good stuff.
Okay, sounds good, Ryan. So just like any other presentation, as always, a quick disclaimer. This webinar should not be construed as investment advice. Always consult with your advisor. Past performance is not a guarantee of future results.
All right. Well, let's start at the beginning with the biggest and the most pressing question, Richard. What are stock options?
So an option is a contract that gives the owner the right, but not the obligation, to buy or sell a particular asset, what we call the underlying stock, at a fixed price, also known as the strike price or even exercise price, for a specific period of time until expiration. Now, each option contract is usually equivalent to 100 shares. The contract also obligates the writer to meet the terms of delivery if ever the owner exercises the contract rate. I know at first it might sound overwhelming, but trust me, as we go along, you're going to get the gist of this.
Thanks for that definition, but do you have a little bit more of a relatable example you can give our audience, Richard?
Yeah, that's a good one, Ryan. Here, for beginners, going through all these new terms and vocabulary, it's very overwhelming. So most times I prefer to use a relatable example. For example, for instance, a real estate transaction. In a real estate transaction, you have the house in question, the property. Well, that is what we call the underlying asset. So the underlying asset can be a stock, it could be an ETF, it could be an index, it could be anything that you can think of. But most important of all, it has to be a tradable product on the exchange. Now, the other thing that I also mentioned is the premium. Okay, the premium is like a deposit. The reason I say like is because the deposit in a real estate transaction, it doesn't fluctuate. But in the case for an option trade, the value of this deposit, what we call the premium, can go either up or down, depending on how the price of the underlying asset or the house fluctuates. That amount that you indicate, okay, we call the strike price. That's the price you're guaranteed to be able to purchase the house at. And just like any contract agreement, it has an expiry date. So this expiry date in the options world is always on the third Friday of the expiration month. But now we also have weekly options, and these are options that expire on every Friday. So make sure that you understand what the expiry date of that option that you're trading is at.
That's a really good example. Well, where are these options traded, and how are they traded?
Options trading is very similar to stocks. In Canada, there are different trading venues for stocks. So under the TSX, which is the Toronto Stock Exchange, and also the TSXV, the Venture Exchange, and those for stock trading. Now, when you talk about options, for options, they are traded on the Montreal Exchange. Now, in the options market, there are call options and put options, and investors use them for different purposes based on what they want to achieve. And there is an option strategy that could help achieve that. So based on what you want to achieve, what your objective is, there are over 30 plus different option strategies. So it's very good to have options.
Yeah, that's a good point. Now, at some point, I always hear mention of calls and puts. What's the difference between a call option and a put option?
Yeah, these two are, let's say, the building blocks to learn about options. Now, to talk about the difference between calls and puts, let's use an option chain. Here on the screen, you see an option chain, And the option chain is basically the place that you go to get an option quote or a price, and also to see what options are available to trade. Now, on this screenshot, first, you'll see the price of the underlying. Here we have Air Canada. At the bottom section, you will see the calls and the puts. Now, for those who hear these terms, calls and puts, for the first time, basically, call options give you the right to buy the underlying stock at the strike price before expiry. Now, investors buy call options because they are bullish on the stock. And put options give you the right to sell the underlying stock at the strike price before expiry. And because they are bearish on the stock. Now, for beginners, here's a good to easier what calls and puts do, okay? Always think of or imagine a phone. When you want to call someone, you pick up the phone, and when you're done calling, you put down the phone. So call up, put down, okay? When you think the market is going up, you use calls. When you think the market is going to go down, you use puts.
That's a pretty good example. I don't think I'll forget about what calls and puts are because of that. So I'm looking at the chart here, or the option chain as you described it. Why are some options more expensive than others?
That's a good question, Ryan. The reason is because some of the options are in the money and some of the options are out of the money. Now, in the money options are going to cost more because they have, now remember, intrinsic value. These again are new terms. So let's break it down and see what they mean. Let's use the $14 call option as an example, okay? Imagine the investor has this $14 call option. What does it mean? It means that she has the right to buy Air Canada shares, which is the underlying stock, at the strike price. And what's the strike price here? Is $14. Now, notice that the stock price of Air Canada is trading at $18.16. That being said, the investor holding this $14 call option has an edge or a benefit of $4.16. So if the investor wants to buy this $14 call option, she needs to pay how much? Okay, the price she needs to pay is $4.25, what we call the premium, the option premium, or the price of the option. The difference between the $4.25 and $4.16, remember what the $4.16 is? The $4.16 is the intrinsic value, okay? Now, if you take the $4.25 minus the $4.16, that difference is 9 cents. That 9 cents that you are paying to buy this call option is what we call the time value. Now, the other important point about this time value notion is that in the options market, you have many more different expiry choices that you can choose from. So one thing that I want to tell you guys is that the more time to expiry the option has, the more time value that you will need to pay for that option. So that is one thing. And the other thing that I'm not gonna, get too much into the weeds is the volatility of the underlying stock itself. The more volatile the stock is, the more expensive the option will be. So maybe the volatility part, we can save this for another segment in the future.
That's good. Maybe something to look forward to in the next segment. So the option buyers have rights. Who is then fulfilling the obligation on the other side?
Right. That's a good question. Now, remember, just like any transaction, even in the options market, there is always a buyer and a seller. Now, for beginners, the most important thing to remember is that when you buy a call option, you have the right to buy the stock. And when you buy a put option, you have the right to sell the stock. The investor selling to you this option is what we call the option seller, also known as the option writer. Now, the very important thing to remember here is that the option writer is always obligated to deliver the stock or buy the stock depending on the option type. It depends if it's a call or a put. So for example, the call writer, who is the counterparty, okay, And in return, she's going to receive the cash amount, which is equivalent to the strike price times the 100, okay, which is the multiplier of an option contract, and times the number of contracts that are being traded at.
So I do hear the term exercising an option. Okay, so could you show an example? And also, why would an investor close an option position rather than exercising it?
Okay, let's take a look at that question and let's dissect this. First, take a look at the table that I have on the screen for the audience right here. We're comparing two things. First, let's explain what exercising is. When you exercise an option, this is basically the action where the option holder makes to convert the option into a stock position. Okay, to exercise an option, the investor needs to call customer service and speak with a representative to do this. And the other option is to close the option position. It's just like closing a stock position. This is the action that you take to unwind the position. So let's use TELUS at $24. And if the call investor buys the stock will go up, therefore she buys a call option. Why? Because she wants to lock in a guaranteed buying price of $25. Now, if we fast forward 20 days later, if TELUS goes up to $27, the call investor can do two things. She can sell the option by closing the position. Okay, by doing so, she can close that position for $2.20 and make a net profit before commissions of $1,970. But the second option that she can do is to exercise the call option. Now, by doing so, you have to remember this, is that she will need to pay $25 per share, which is the strike price. This also means that she needs to have that in or cash in her trading account to exercise a call option. So to answer the second part of your question, Ryan, why would an investor close a position or exercise a position or a call option? It depends on what she wants to do. If the investor wants to just, buy the option and then sell it at a profit, that's fine. But the second thing is, let's say if she wants to become a shareholder, then the way to do this is to exercise the call option.
That's interesting. Well, how about you run us through an option trade, if you don't mind?
Sure, my pleasure. Now, and let's use that as an example. And we want to get in and buy Canadian Tire at 120 and then sell it at 138 and make a nice profit. Now, you have two ways of doing so. Using a stock, it's always buy low and sell high. But that's the same thing with options. You want to buy an option and pay a premium and then wait for the stock to go up, the option premium or the option price is going to go up, and then sell at a profit. Now, let's use Trader A and Trader B. Both, they are bullish. They think that Canadian Tire is going to go up. One will use stocks and the other one will be using options. So in the next slide, I'm going to use a table to compare the pros and cons between both traders. So as you can see here, Canadian Tire is trading at 120. The option trader is going to buy a call option, 935, which is the option premium. Now, take a look at the calculations and the math behind this, and you're going to quickly see the very first benefit of using options is that the capital outlay is lower using options. And both investors or traders have the same exposure. The stock investor is buying 100 shares, and the call investor is buying one call option, okay? Because one call option is equal to 100 shares. Always remember that, because sometimes when I speak with new investors trading options, they tend to think that one call option is one share and that they need to buy 100 call options to have 100 shares exposure. So don't make that same mistake. So let's say if Canadian Tire goes up to $138.80, hey, both traders are making a profit, but notice the return of each trader. 15% versus 104%. So this is the second benefit of using options, is the leverage. Because a 15% increase in the price of Canadian Tire generated a 104% profit for the call buyer. Why is this? Is because the capital required to attain the same exposure in 100 shares is a fraction of the cost.
So, Richard, with this comes some risk, right?
Yeah, Ryan. Just like any type of investment, there's always risk involved. Well, the risk in trading options is that, let's say, Canadian Tire doesn't go up, but instead it drops to $100. Now, for both traders, the stock investor and the option investor, they would both lose money. The stock trader would be down $20 per share, or 17%, whereas the call buyer holding that call option will become out of the money. If it remains out of the money by expiry, then the investor is going to lose 100% of how much she paid to acquire that option, which is $935. Now, for those who see this, they can also, say that, hey, $935 is also a benefit. Why? Because by purchasing a call option, you know in advance what is your maximum. Now, the other risk about trading options is that when time is not your friend, because the value or the time value of the option premium is going to decay or depreciate over time. So as the option approaches expiry, that option premium is going to decay. What's going to remain at the end on the expiry date is the intrinsic value. Now, for stock buyers, on the other hand, they can hold on to the stock and wait for it to recover. But mind you, nothing is guaranteed. Nothing is going to guarantee that the stock is going to recover. For instance, I still have my stock certificate on my Montreal shares.
Well, I guess you can have that as a nice memory of what not to do, right?
Yes.
Okay, so I've decided that I want to do options. If that's the case, do all stocks have options? And if so, where can I find a list of options? For example, on the Montreal Exchange?
Yeah, that's a good question, Ryan. The answer is no. Not all stocks or ETFs have options. And the reason is because at the exchange, we look at different before listing options on liquidity and trading volume on the underlying before that stock or ETF is going to have options on them. For those who want to find out the entire list of companies that have options, you can visit our website, which is m-x.ca, and simply go over to the option list, and you're going to get the entire list of securities that have options.
Perfect. And let me show you how to do it in WebBroker as well, if you have a stock in mind and you want to find out if there's an option chain on it. In order to see if your stock has options trading on it, while you're researching your stock, click on the Options tab. If your stock has options, you will get an option chain, as seen here below. If the stock that you're researching does not have options, you'll see this message. Now, in order to trade your options in WebBroker, click on the Buy/Sell icon. Click on the Options tab. Enter the symbol of the security that you'd like to trade. Notice the quote comes up on the right of the stock itself. In order to enter in the option that you'd like to trade on this stock, you can manually choose your expiry date, strike price, and or call or put selection through these drop-down menus. You can also click on the option chain right next to the symbol box. You'll now get the option chain. Here you can choose the different expiries, and you can choose which option to trade. For example, if we'd like to trade a call option and we'd like to buy one, we'd be clicking on the ask. So let's click on this one. Once the option is chosen, you'll see the option quote on the right. Now let's put in the quantity. Remember, if I put 1, that's one contract. One contract will equal 100 shares. I then choose the price type. It can be limit, market, or stop limit. Let's stick with limit. We can adjust the limit price if we'd like. So let's do that. And we can choose how long we'd like this order open, for the rest of the day, until a specific date, or good till cancel. Let's leave it at day. Once we're happy with all of our details entered, we'll click on Preview Order. Preview Order will give us a total cost of our order and have a breakdown of the commission as well as the principal of this order. If I'm okay with the details, I'll merely click Send. And that's it. My order is sent. In order to see the status of my order, I can click on Go to Order Status. And here I can change the order or cancel the order or just check the status of the order. All right. So to summarize, Richard, are there any tools or resources to just practice trading options in a sort of risk-free environment?
Yes, Ryan. But education combined with practice can become very powerful. And that's why the Montreal Exchange offers a free trading simulator where you can place any paper trade on stocks, ETFs, and options. Now, the best thing about this free trading simulator is that you can put on any option trade and watch how it evolves over time. And the best of all is that if you don't get it right the first time, you can always repeat and practice some more. And then, sure enough, with enough practice, once you build enough knowledge and confidence, then you can trade with actual money. So you can visit our website and sign up for a free trading simulator.
And if you'd like a link to that, we've put them in the list of resources to your right. Well, thank you so much, Richard, for joining us today. I know a lot of our clients really enjoyed kind of going through those option beginner items. So thanks again for joining us. For those of you in the live session, we now move on to questions.